Welcome back, Business 100. We're going to take a look today, Chapter 10, the financial markets, how the financial markets can actually play a role for business.
And the first thing we have to do is remember what a business's primary function is. We've talked about it briefly before in earlier chapters. If we haven't, let's take a moment and let's think about what that is. So think about in your head, what is the primary purpose of a business? And I don't care if it's a small business, a mid-sized, or large corporation. What's the primary goal? Okay, time's up. The primary goal of a business is to make a profit. If you're a small business
and you're not making a profit, you're not going to be in business long. If you're a corporation and you're not making a profit, you're not going to be in business long, right? So primary goal, make that profit, okay? So let's jump in with that in mind. Let's jump into the presentation. All right. So here it is, right? We have to make a profit. And particularly there's corporations that need to make that profit for their shareholders, right? Disney, for example. If I'm invested in Disney, if I'm invested in Apple, if I'm invested in Coca-Cola, I want these companies to be profitable. That's how I make a profit as an investor, right? That's how I make money. So if you're a shareholder for a big company, that's what you're looking for that company to do. So no matter what, even if you're a small business, right, you have to make a profit. That's the goal. So keeping that in mind, let's take a look at the outcomes for this chapter. We want to take a look at the role of the financial markets in the U.S. economy and identify the key players in the markets. We want to take a look at the key laws that govern the way financial markets operate and explain the impact of each law. We're going to take a look at and compare the major types of securities that are traded in the securities market. We're going to explain how securities are issued in the primary market and traded on the secondary markets. We'll look at several strategies that investors use to invest in securities. And we're going to interpret the information provided in the stock quotes available on financial websites. So if it weren't for the financial markets, companies would have found it difficult to fund operations. Okay, we have some of the things that we talked about the last chapter, right? The different types of banks that are out there and the different ways to fund or finance a company. But the markets also help us payroll, invest in new facilities, develop new products, essentially compete in the world marketplace. Funds are used specifically for those purposes, especially making investments in infrastructure, competing on a global stage. These are key. And it's not just the markets themselves, commercial banks, credit unions, savings and loans associations. These are all different avenues that corporations, companies, small businesses can take advantage of. So apart from banks and other depository institutions, there are other financial intermediaries that play an important role in the financial markets. They're referred to as non-depository institutions. During most of the 20th century, the federal government responds to financial upheavals, the Great Depression, the recession, right? They respond to financial upheavals by introducing new laws and regulations. Congress formulated 2 laws that laid the foundation for the U.S. securities market regulations in response to the Great Depression, the stock market crash of 1929. That was the Banking Act and Securities Act of '33, right? In the 80s and 90s, Congress responded to the criticism they received regarding their policies by easing the regulation on depository institutions and banks. And they responded to them with several different rules. The last 3 you see on the slide, right? The Dodd-Frank
Act of 2010 we touched on in the last chapter, right? This was in response to the recession of 2008, 2009. So there are certain basic rights that common stockholders have as they are considered owners of a corporation. Some companies issue preferred stock. As the name suggests, preferred stocks provides preferential treatment to stockholders. There are a number of different types of bonds that one can choose from. Some of the basic characteristics of these bonds includes the maturity date, par value, coupon rate, and the current yield. Convertible securities are issued by certain corporations. Mutual funds can be structured in two different ways: closed-ended funds and open-ended funds. The initial distribution and creation of exchange-traded funds differ from mutual funds in a few aspects. Mutual funds, for those of who aren't unaware what mutual funds are, how they act, they're a basket of securities. It's a way to decrease risk for investors. So if I have $100,000 and I put everything into Microsoft, right? Seems like a safe investment. Seems like, you know, Microsoft's not going anywhere, right? Everyone return Microsoft. I mean, we're looking at Microsoft PowerPoint right now. Right? Pretty safe, right? But what happens if there's a scandal? What happens if the accounting department has essentially embarked upon widespread fraud and misrepresentation and misreporting? Suddenly, the stock takes a nosedive, and my $100,000 could represent half of my retirement at this point in my life. I'm not going to retire anytime soon. Let's say it's half of my retirement. I put it all in Microsoft, and it takes a nosedive, and suddenly now my $100,000 is only worth $10,000. That's a disaster, right? So mutual funds were created to allow investors to get a piece of Microsoft, but also spread out that 100,000 across a slew of different companies and holdings. There are mutual funds that have stocks and bonds in them. There are mutual funds that only invest in large corporations. There are mutual funds that only invest in tech companies. The menu of different types of mutual funds is wide and diverse, but the idea again is to spread out that risk. So if an individual company inside your mutual fund goes down, your entire portfolio, your entire $100,000 won't go down with it, okay? Now, exchange traded funds are very similar to mutual funds. They're that same basket of securities, right? And the types of exchange traded funds are just as varied as mutual funds. The biggest difference between mutual funds and exchange traded funds is how they act and how they can trade. There are restrictions, timing restrictions, for example, in mutual funds. You can invest into it, but it might be a few days before your investment is approved and live, so to speak. Exchange traded funds are much like stocks. You invest, and as long as the business is open for the day, you're good to go. You're live, you're active right away. That's just one example. That's a really basic example. They act very similarly though, because they diffuse the risk involved with the investment. Okay. So as owners of a corporation, common stockholders have certain basic rights. Under the most common arrangement, stockholders can cast one vote for each share of the stock they own. I own 100 shares of stock, I get 100 votes, right? All common stockholders have the right to receive a dividend if their corporation's board of directors declares one. Capital gains can create a very attractive financial return for stakeholders. In several states, a preemptive right is only available if it is specifically identified in the corporation's charter. And residual claim comes after all other claims have been satisfied. Some of the features of bonds: long-term bonds issued by corporations usually mature 10 to 30
years after the issuance. But longer maturities are possible, okay? Bondholders can sell their bonds to other investors before they mature, but the price they receive might not correspond to the bond's par value because bond prices fluctuate with conditions in the bond market. When a bond's market price is above its par value, it's selling at a premium. When its price is below par value, it's selling at a discount. Unlike dividends on stock, a firm has a legal obligation to pay interest on bonds and to pay the bondholder the par value of the bond when it matures. Again, we're talking about mutual funds again. This slide will list the different features that make mutual funds a popular choice for investors. Mutual funds do
have some drawbacks. Perhaps the most serious is the professional management touted by many funds, and it doesn't come cheap, right? investors in mutual funds pay a variety of fees that typically range from 1% to 3% of the amount invested. So let's go back to my original example of $100,000 that I've invested in mutual fund. If 3% of that is going towards management fees on an annual basis, that means right off the top, my $100,000 investment now becomes a $97,000 investment. If the money loses value, then I'm losing even more, right? If the mutual fund decides not to perform well, then I'm losing even more money. But the management fee gets lopped off the top. There are mutual funds out there that do not have management fees associated with. Most popularly, these are the Vanguard mutual fund family. These are not professionally managed. They are sort of a set and forget it type scenario. But they're very popular because they won't take that 3% off the top of your investment. Okay. So index funds, exchange traded funds, no load, they're called no load or no fee mutual funds. If you're an individual investor, hint, hint, these are the types of funds you should look for. My own 2 cents. I'm not a professional financial advisor, so please don't take that as professional financial advice. Okay, so corporations that sell newly issued securities to increase financial capital are referred to as primary securities. Private placed securities need not be registered with the SEC, the Securities and Exchange Commission. When compared to public offerings, private offerings are simpler, quicker, and less expensive. Think about it this way. Companies, before they go public, right? We hear that IPOs, intent to public offerings, or introduction of public offerings, if you will, IPOs, right? Before they become an IPO, they've raised money privately, right? Especially a lot of small businesses. Right now, you'll see a lot of small businesses get that sort of angel round of investing. These are investors that expect their money back. But if the company goes public, then they become shareholders. They own stock in the company, right? And so there's private funding, there's public funding. That's private placement, public placement, very similar in that aspect. So the firms that issue stocks and bonds don't receive any additional funds when their securities are traded in the secondary markets. But few investors would want to buy securities issued in the primary markets without the liquidity and the possibility of earning capital gains provided by the opportunity to sell these securities in the secondary market. When we talk about personal investing, choosing the right broker is the first step in implementing one's investment plans. Now, there's several different types of brokers out there. You know, you have full service brokers. They provide a wide range of services, including carrying out the trades. Discount brokers, they'll provide basic services to buy and sell securities. At the end of the day, whether or not you use a professional is completely an individual decision. Do your research. A lot of times people will choose someone they know or a family member knows. I know plenty of people who do that themselves. They handle their own investments. My dad did that for years and did quite well. Completely an individual choice. Understand that when you hire a professional, they're going to charge a fee. So if you have $100,000 to invest, they might charge $5,000 for a financial plan and to manage your assets. Now you have $95,000. So just understand with that level of assistance, you're going to get, there's going to be fees involved. The flip side of having that level of assistance is this. Again, if you're that website developer, you're not an expert in the securities market. You're willing to pay a fee to have someone, an expert, look after things for you and check in with you and ask you, do you want to do A or do you want to do B? Here's my 2 cents, here's my advice. It's well worth it from a time perspective. I'm not sitting up at 10:30 at night on a Thursday and now I have to look at my retirement portfolio because the market took a dive today. Like, do I have to do something? So from a time perspective, it's actually well worth the fee. From the expertise perspective, well worth the fee. Okay, so these are things to consider when we're talking about personal investing. Once individuals have set up their account, they can trade securities by contacting their broker and indicating the security they want to trade and quantity they want to buy or sell. They can also specify the type of order they want to place. There's strategies for investing as well. We can invest for income. Specifically, I'm investing in a fund, a stock, because it's going to generate a stream of income for me individually, for me, for my company. So investing for income, specifically choosing securities for the purposes of generating money. Market timing is a strategy. It's not a very good one, but people still do it. I think the market's going to go up because we got a new president. I'm going to invest now. Or, oh my goodness, there was 4 plane crashes over the last month and a half. Boeing's going to tank up getting out of the airline industry because no one's going to want to fly a plane for the next 3 months, right? Things like that. It's not very scientific. It's all based on gut. Some people say they have data to back it up. The truth of the matter is market timing is not a very secure way to strategy to invest. And that's my opinion. You'll find probably 10 other opinions who believe that market timing is the way to go. Investing for growth. Again, this is a time-driven investing strategy. You're investing in different companies and in different securities that are going to grow over the long term. Value investing, finding a company that may have done really, really bad in the last few years, but you know it's going to be ripe for a comeback. Think right now maybe movie theaters, right? No one's gone to a movie. It's the global pandemic. Movies are going to be making a comeback soon, and there's going to be a lot of opportunity there. Buying and holding stocks is one of the biggest strategies that people use for retirement purposes, right? I'm going to buy a stock now. I'm going to hold on to it for 20 to 30 years, watch it grow, liquidate it when it comes time for me to need for retirement income. One of the most common ways to track general market conditions and trends is to follow what's happening to the various stock indices. Some of the 2 major ones include the Dow Jones Industrial Average and the Standard & Poor's 500, or the S&P 500, right? We hear about this every day on the news. For whatever the reason is, news organizations have decided that these are the 2 indices they want to report on. And so we'll get the totals for the day on the nightly news, right? So many investors like to compare how those stocks are doing in their own portfolio as compared to these 2 primary stock indices or stock indexes. So the following couple slides, the following slide here, takes a look at the different index that's out there. The NASDAQ's probably the 3rd most popular. This is all the domestic and foreign common stocks traded on a NASDAQ exchange. A lot of times we see a lot of some of these tech companies that aren't on the S&P 500 or the Dow Jones, they'll be on the NASDAQ. I think Apple was in there for a long time. So each of these has a different area of focus. A lot of times if you, for example, are someone who likes to go after the smaller companies because you think they're going to hit big, the Russell 2000 is a way to look at your portfolio of small stocks, small business stocks, and see how it's performing versus that particular index. And that's what a lot of investors do. Again, that's what a lot of brokers and financial planners will do. They'll compare a client's portfolio against some of these indexes because they're very similar in strategy and in the holdings. Many financial websites offer a detailed stock quote that provides the current price of company stock and a wealth of related information. Yahoo Finance, Bloomberg is a great one. There's Moody's. There's a slew of different places to go to take a look at stock information, corporate information, mutual fund information as well, and bonds. All right, so key terms. Here's the big thing, folks, when we're talking about the financial markets, when we're talking about how corporations use it as another way to leverage and generate revenue, right? It's a way to help them increase their market or increase their market share in their particular industry. For small business owners, it may or may not be a way to help leverage themselves and have a way to generate income in addition to sales. But typically, you're not seeing that solopreneur, that individual sole proprietor, that website developer have a key portion of their assets in the markets, at least not early in the game. Perhaps a bond position or a mutual or a money market position if they've got cash that they want to see generate income, right? Those money market accounts, those CDs, if you will, certificates of deposit, can generate anywhere from 2 to 4%, 5% sometimes over a specific short amount of time, and it might be a way for them to boost their cash position. But traditionally, you're not seeing that. Traditionally, you're not seeing that from small business owners. Corporations will leverage themselves using the markets to create stronger positions for the midterm and the long term. All right, that was chapter 10. We'll be jumping into chapter 11 soon enough. Thanks for tuning in, and jump on those assignments, jump on those discussion boards, keep hitting the book pretty hard, okay? We'll see you soon.